All right, let's dive right into this explainer. Today, we're looking at a financial catastrophe that permanently, and I mean fundamentally, changed how global markets operate. We're going to break down the anatomy of a disaster, the 1987 stock market crash, which you probably know as Black Monday. This was literally a day when the financial world stared right into the abyss, and, well, the machines took over. 22.6%. Just let that number sink in for a second. That staggering figure represents the drop in the Dow Jones Industrial Average on one single day, October 19th, 1987. Imagine nearly a quarter of your entire wealth just evaporating while you're pouring your morning coffee. That 508-point freefall is still the largest single-day percentage drop in U.S. stock market history. The sheer scale of it is almost hard to comprehend, right? So how exactly did we get there? Section 1. Warning signs before Monday. To understand how a collapse like this happens, we have to look at the creeping tension leading up to the crash. Think of it as the visible tip of a very, very dangerous macroeconomic iceberg. You see, throughout the 1980s, the S&P 500 index was on an absolute tear. But leading up to October 1987, things got out of whack. Price increases were wildly outpacing actual earnings growth. Commentators at the time were already sounding the alarm, saying, hey, the market is severely overvalued, we desperately need a reality check. But, a market correction is one thing. A total, sudden collapse, that is a completely different beast. All these underlying macroeconomic pressures were bubbling up everywhere. We had rising global interest rates, a growing U.S. trade deficit, and a noticeably declining U.S. dollar. This whole pressure cooker finally culminated in a terrifying drop on Friday, October 16th, taking a massive 108-point hit. And because trading stopped for the weekend right after that, it left this huge hidden overhang of unexecuted sell orders. Imagine Wall Street executives going home for the weekend perfectly knowing a massive storm was just hanging over the market, waiting for the opening bell on Monday morning. Section 2. The Black Monday Collapse. And man, when Monday morning arrived, the floor completely fell out. An absolutely unprecedented volume of sell orders paralyzed the entire system. The physical chaos was overwhelming. In New York, the imbalance was so extreme that many market specialists just refused to open trading for major stocks. Some wouldn't even pick up their phones. Paper trading tickets were literally piling up in physical drifts on the trading floor because the human systems just broke down. As major indices in London, Hong Kong, and Sydney collapsed in unison, Andrew Grove, who was the CEO of Intel at the time, observed, "It's a little like a theater where someone yells, 'Fire.'" And for the very first time, thanks to modern communication, everyday investors watched live on television as this crisis spread across the globe like a virus. It was just pure, contagious fear. Section 3. The Limits of Financial Modeling. So let's peel back the layers here and reveal the real villain of this story. It wasn't just human panic. Actually, it was the fundamental limits of algorithmic financial modeling. Enter a brand new, highly popular strategy called portfolio insurance. These were dynamic hedging programs heavily adopted by huge institutional investors, and they were designed to automatically sell stock index futures as equity prices fell. The terrible irony here? Wall Street felt completely invincible. These computer programs were mathematically engineered to protect investors from downside risk. They were supposed to act as a foolproof automatic safety net for massive portfolios. But here is the multi-billion-dollar question we have to ask. If these models were built to protect the market, why did their automated selling actually exacerbate the panic instead of containing it? The answer lies in this devastating contrast between theory and reality. Those rigid financial models naively assumed a normal market. Continuous liquidity, independent human decisions, but they were utterly crushed by the reality of Black Monday. Liquidity simply evaporated. Poof, gone. And this clustered panic selling was combined with an event known as triple witching, which sounds spooky, and honestly, it kind of was. It's a perfect storm where 3 different types of derivative contracts all expire on the exact same day, forcing massive, unavoidable trading volumes. The algorithms completely failed to account for a scenario where literally everyone rushed for the exact same exit at the exact same time. So what was the final result? The algorithmic models destabilized the very system they were created to protect. Instead of saving the day, the sheer volume of automatic sales from portfolio insurance completely overwhelmed the clearinghouses and transaction systems. It created this doomed feedback loop of algorithmic panic. Prices dropped, so the computers automatically sold more, which dropped prices further, triggering even more automatic selling. The machines were blindly following their orders right off a cliff. Section 4. The Federal Reserve intervenes. right as these rigid financial models broke down and the clearinghouses faced this intense strain, a true stabilizing force finally emerged. And it wasn't a better computer. It was the flexible, discretionary human judgment of the Federal Reserve. Newly appointed Fed Chairman Alan Greenspan issued a decisive Tuesday morning statement saying, "The Federal Reserve affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." That loud, public commitment served as the ultimate calming force. It proved that, at the end of the day, institutional human judgment was required to rein in the machines. And the Fed backed up those words with immediate action to bypass the broken algorithms. They aggressively carried out open market operations, pushing the federal funds rate down to around 7%. But crucially, they extended the operating hours of the FedWire payment system. That meant the literal physical pipes of the financial system stayed open, so massive amounts of money could move when it was needed most. By actively encouraging commercial banks to lend freely to Wall Street firms, the Fed injected this highly visible emergency liquidity right into the system, reassuring investors and finally breaking the fever of that market panic. Section 5. Circuit breakers and lessons learned. In the aftermath of the crash, regulators had a massive wake-up call. They realized that because financial markets were no longer just human, they needed entirely new structural safeguards to prevent a sequel. This realization led directly to the birth of surge protectors for global equity markets, what we now call circuit breakers. Following a bunch of extensive postmortem studies, exchanges implemented these pre-established coordinated rules. They're designed to temporarily pause or completely halt trading. It gives human investors a moment to breathe, assimilate incoming information, and physically break that blind feedback loop of automated selling. And you know, these safeguards are still hardwired into the markets you interact with today. Here is exactly how they work in practice for the S&P 500. If the market drops 7%, it triggers an automatic 15-minute trading halt. Bam, timeout. If it drops 13%, that's a second 15-minute halt. And if it hits a massive 20% decline, the system forcibly pulls the plug on trading for the remainder of the entire day. It is a literal off switch to stop the algorithmic bleeding. So as you think about the incredible, chaotic events of October 1987, I want to leave you with this provocative thought. As our financial markets become increasingly automated, faster, and way more interconnected than ever before, can human judgment permanently contain the risks generated by algorithmic speed? Have we truly mastered the machine, or are we all just waiting for the next invisible flaw in our financial modeling to reveal itself?